Hello, my name is David Prowse, and you're listening to the Fitch Ratings Fixed Interest Podcast. Today I'm interviewing one of our usual podcast hosts, Justin Patrie, to discuss the state of global credit risk at mid-year. So, Justin, you've just published the latest quarterly Fitch Risk Headquarters report, which outlines key risks to global credit. How have the key risks evolved since the last quarter?
Thanks, David. Yeah, so the short story is that it's actually been a largely positive story for credit risk since the beginning of the year. And developments over the second quarter have actually just reinforced that. US growth and consumer demand has held up better than we originally expected at the beginning of the year. We're now looking at a less dramatic deterioration in US growth over the second half of the year. Geopolitical risk, that remains a key concern, but over the first half of the year, we haven't seen any deterioration in geopolitical risk. Commercial real estate as well. That was another key risk that we've been flagging. It remains a major issue for several sectors, but it did not trigger any larger systemic liquidity crunch or credit unwind that would be a larger risk to credit globally. And in Europe too, we've started to see the green shoots of a slow recovery. So generally, the macroeconomic environment has been very supportive for credit and mitigation of credit risk. I'll add that in emerging markets outside of China, there's been a lot of positive news, both in terms of funding and liquidity and in terms of growth, policy reform. We've upgraded our growth forecast for Central and Eastern Europe, Turkey, India. Demand has been quite strong in these kind of major EMs. And all of this has also been reflected in rating actions, mainly in the investment grade space. So investment grade upgrades have exceeded downgrades by the largest amount in years in the second quarter. And there still is a positive outlook bias for investment grade ratings where positive ratings outlooks outweigh negative ones.
Okay, but while the credit risk and ratings trends have been positive, where do we think the greatest negative risk could come from?
Yeah, despite the positive data and trends so far, it's really important to not get complacent with regard to credit risk because all the key risks that we've been flagging for several quarters, they remain. Though the developments have been largely supportive of mitigating those risks, they're still there. So China and China housing remains a key risk, and this is an area where we haven't seen a marked improvement since the beginning of the year. The residential property sector in China has shown little signs of recovery. Sales continuing to contract, investment it remains way down in the housing sector, and there are bigger concerns about the effects this is having on the wider economy. Our economics team has been flagging the deflationary pressures resulting from weakened demand in China for a while now, and there are risks from feed-throughs to the financial consumer and other corporate sectors. Notably, we revised China's sovereign outlook, ratings outlook down to negative back in April, and the increasingly uncertain economic outlook and the transition away from property-reliant growth were factors in that too. So another thing that I think it's important to mention is real estate in the US and Europe, and particularly office commercial real estate. So these still face valuation declines. Now, because of the nature of the sector, the long-term leases, those declines can take place over many years, the realization of those valuation declines. But there's no question that this is a sector that is going to continue to face a highly uncertain secular transition, and a lot of which we can't really be certain about in terms of how it's going to feed lenders and other sectors that are exposed to office commercial real estate. And of course, above, I mentioned geopolitical risk. This has definitely not gone away, and it's going to continue to be a key risk.
Okay, and what about interest rates? That's been a major concern for fixed income investors for several years now. Is it still a credit risk?
Yes, very much so. It's important to not ignore the issue of rates and what I just kind of describe as generally higher borrowing costs, despite the fact that monetary loosening has begun. The European Central Bank and Bank of Canada, among the developed market central banks, have taken the lead. The Federal Reserve is likely to cut rates soon in September. And market and consumer demand has held up despite the fact that rate cuts have been a little bit less than expected relative to what was initially expected at the beginning of the year. So there's a lot of things that would suggest, well, the risk from rates have mitigated, because of all these factors since the beginning of the year. But if you take a step back away from the shorter term trends, it's important to remember that rates are still materially higher than they were just 2-3 years ago, and that the pace of monetary easing is likely to be quite gradual. So you still have a broader situation where refinancing for many companies is having to take place at a higher rate than when leverage was previously taken on during the zero interest rate period in the US and Europe. And it's notable that the more rate-sensitive borrower categories are still showing some signs of pressure despite the pending rate cuts. We're still forecasting high-yield and leveraged loan default rates to rise in the US and Europe. Subprime consumer lending continues to look weak, and some asset quality deterioration is still expected in developed market banking sectors. And it's also kind of important to note or to recognize that we haven't seen the sort of positive ratings momentum in sub-investment grade as we've seen in investment grade. And I think part of that is still the higher kind of rate environment that we're still in.
You mentioned geopolitical risk earlier. How's Fitch thinking about this?
So it's pretty unlikely that the heightened period of geopolitical risk that we are in is going to go away anytime soon. So geopolitical risk has been a key risk for a while. It's going to remain a key risk for a while. There's been no change in the kind of the tail risks from conflicts in Eastern Europe and the Middle East. And the general secular shift towards geostrategic competition between the US and China, that is going to continue to drive key trade and foreign policy decisions in both those countries and in Europe as well. And if anything, as the US election heats up, it's a reminder that there is bipartisan consensus in Washington towards policies that promote reshoring and reinvestment in the country's domestic manufacturing, and that's going to continue to contribute to sort of trade and policy tensions with China. So overall, with regard to geopolitical risk, one of the things that we can think about it is in terms of two ways. So first is tail risk events. So a tail risk event, which is a low probability but high impact event that has a sudden and sharp effect on large numbers of credits. The Russian invasion of Ukraine is a good case of this. And secondly is the more broader geopolitical tensions that are affecting policy decisions, and that's kind of the geostrategic competition between the US. And that is not so much a tail risk issue, but more about a slow, long-term effect on business policy and investment decisions that in turn can affect growth, supply chains, leverage for companies that have to invest more in readjusting to the new environment and so forth. So those are kind of the two areas that we think about in terms of geopolitical risk.
And just going back to the US election that you mentioned earlier, to what extent is that a credit risk?
Yeah, so the US election is clearly a major point of uncertainty. Maybe it's the major point of uncertainty, at least for certain countries and sectors. Elections matter, and who wins the presidency and the various scenarios of congressional election outcomes is going to be a key determinant of US legislation, administration, federal policy over the next, several years, 2 years for the congressional House term and, 4 years for the presidential term. It's difficult to say exactly what a Harris presidency would look like, given she has only recently begun her campaign, but given she's the vice president under Biden, I don't think we would expect a substantive shift from the sorts of fiscal and economic policies that have been supported by the current administration. By contrast, a Trump victory would likely be a substantive change in US policy in several areas. And we actually recently published a report that outlined these policy areas that we think are going to be the most impactful to credit under a presidential transition. And these are the sort of the policy themes that we would be looking at to say, okay, well, if there were Trump election victory, these would be the policies that we'd be looking out for that would matter. And so there were 7 of these policy themes. First was trade protectionism. Second was continued fiscal pressures. Third is geopolitical repositioning and foreign policy. The fourth is climate policy rollbacks. The fifth was financial deregulation and privatization. The sixth was social policy reform, so healthcare, education, and housing. And the seventh was restrictive immigration policies. So of these, fiscal pressures and trade protectionism would be continuations of existing themes, though we would expect them to be augmented under a Trump administration. The other areas, that's kind of third through seventh theme, these would mark more major pivots for credit. And for those interested in terms of the more specifics of the feed-throughs and the credit sectors that we think would be affected, you can take a look at the report online.
Thank you, Justin. Hope you enjoyed this fixed interest podcast this week, and thank you, Justin, again for being on the other side of the interview this time. As always, to learn more about Fitch Ratings and credit views, please visit our website at fitchratings.com.